I mean, the market is clearly struggling here and looks a little tired. 5 years into a recovery cycle, it's what you might expect to see. We're clearly seeing some signs of exhaustion, fatigue, following a very strong couple of years in terms of returns. And that's really a combination of high valuations and some deteriorating earnings trends with a slightly softer economy.
Mm-hmm. And you talked earlier about the fact that indices are not necessarily capturing some of the PE ratios or the earnings expectations that have been put on a number of the stocks within the market. Can you just explain that, how you're seeing that?
Sure. Now, breadth is an important consideration when you look at market values, and the indices don't often capture some of the skews that we can see, which really reflect the size of the companies that make up those indices. So because our indices are dominated by the large companies, BHP, Telstra and the banks and so forth, the valuation measures that you might normally look at as a measure of market value don't often fully capture just how cheap or expensive the broader market is. And so if you look at an average valuation, say for the ASX 300 group of companies, which is the larger companies and the smaller companies as well, what you find is the average valuation is actually at a record high over the last 30 years, which really reflects the extremes that we're getting to in terms of valuation. And I think explains also why the stock pickers are really struggling to find ideas, because the market overall at a broad level is fully valued. There aren't a lot of opportunities out there to find mispriced securities or cheap securities.